Splendid evening it is to viewers. Welcome to Equity Access, your aerial perspective of stock market developments and of developments in the Zimbabwean economy. Thank you for joining us as we broadcast live from Hampton Studios. I'm Ibn Mabunda. Let's roll. Just in from a post-cabinet briefing, the Minister for Information and Publicity, Honorable Monica Mchangwa, says that the South African government will engage Eskom for resumption of power supplies to Zimbabwe. This follows President Edi Mnangagwa's engagement with his South African counterpart after Zimbabwe had paid a part debt payment of $10 million to Eskom. Meanwhile, government is also looking to engage Mozambique for favorable power supply terms. On another note, Minister Mchangwa also expanded that government is working on a plan to address the fuel crisis that the country is currently grappling with. Let's just have a look at the footage from the post-cabinet briefing for perspective.
First, their country's firm commitment to assist Zimbabwe to overcome its current energy and power supply challenges. As a consequence of this encouraging development, the Minister of Energy and Power Development, as we speak, is currently in South Africa and is soon to head to Mozambique for detailed discussions with his counterparts on possible increased power imports to Zimbabwe. The nation will be advised on the outcome of the discussions in due course. And on fuel, Cabinet was briefed that urgent steps are now being undertaken to roll out the fuel tracking technology throughout the country. That is on the energy. Then Cabinet received a report on the mining investment seminar which was held in Perth, Australia. The Minister of Mines and Mining Development, Honorable Chitando, attended this mining investment seminar which was held in Perth, Australia from the 26th to the 29th June 2019. The event, which was organized by the Zimbabwe's Open for Business Forum in Australia, afforded the minister and his delegation the chance to present mining investment opportunities in Zimbabwe to various potential Australian investors. As a testimony to the resounding success of the seminar, several follow-up engagements with the potential investors are due to take place later in August 2019 in Harare and September 2019 in Perth in Australia. That is for the report on the mining investment. First, their country's firm commitment.
As Zimbabwe's economic woes persist, Finance Minister Professor Mthuli Ncube has hinted on what he calls a cushioning allowance for civil servants. This he said at a business summit held in the capital recently. Questions then would be raised as to whether this increased government spending will still be in check with the minister's preset fiscal policy. Meanwhile, government says bread supplies are set to improve in the coming days following the arrival of 19,000 tons of wheat which had been bonded in Beira. This comes after government paid $7 million to the carriers in Mozambique. Beyond our borders, the region's biggest trade bank, Afreximbank, invests $1 billion toward the establishment of the African Continental Free Trade Area. The development follows the official takeoff of ACFTA over the past weekend. The fund, named After Adjustment Facility, is an effort to achieve more than $3 trillion in value on trade on the continent. The bank also launched the Pan-African Payment and Settlement System, the first continent-wide payment digital system focused on facilitating payments for goods and services in intra-African trade in African countries. This concludes our evening news bulletin. Up next is a look at the news under News Review. Don't go anywhere.
Climbing to the top takes more than just hard work and smart choices. It's the passion that drives you from within, the endurance to keep going through difficult times, and having a very clear vision of how to succeed. That's what we strive for at CBZ. We're a diversified and innovative listed financial services group in Zimbabwe, with a complete range of activities, including banking, short and long-term insurance, asset management, and property investments. CBZ has been a pinnacle for stability in the economic landscape of Zimbabwe, stemming from our deep-rooted values, our excellent customer service delivery, and our corporate vision to strive for excellence as a global competitor. Our continuous investment in research and development will cement our promise to provide customer convenience utilizing state-of-the-art technology. Relationships are at the core of what we do. We understand, however, that strong, long-lasting partnerships are not built overnight. With over 3 decades of wealth management, we have come to understand our clients and their specific investment requirements. Our unique mix of skills ensures that investment opportunities are examined from all perspectives. The balancing rocks of Zimbabwe have weathered the elements for thousands of years and stood the test of time, like majestic reminders of the fine balance of nature. They challenge our perception of what is possible and what endures. Just as CBZ has weathered the economic storms and remained steadfast throughout the turbulence of unsettled economies. Achieving the impossible through resilience and stability, we balance the elements of hard work, dedication, and experience, making us your ideal partner for success.
Welcome back, viewers. It's now time for news review, and with me on set is Chief Analyst Respect Gwenzi. Respect, good evening and welcome to the show.
It's always my pleasure, Eben. Good evening to you too.
Thank you, Respect. Beautiful. Now let's get the ball rolling. First and foremost, the Minister hints on a cushioning allowance. How good is that for his fiscal policy?
Yeah, this is something that obviously was unavoidable getting into the second half of the year, looking at all the issues that happened from the beginning of the year, getting back to our own dollar, the depreciation that followed on our currency, and all this had put enormous pressure on the local currency, and subsequently the government had already planned to adjust its second half budget. Why? Because the 2019 budget as issued in November of 2018 was premised on an USD currency. So the budget was in actual US dollars. So now that we are now operating a local currency driven economy, there's need for adjustment in certain key parameters. But consequently, what this also means is that there is need for looking for alternative sources of cash to finance that same budget that is going to present. So the budget is coming from a figure of about 8 billion to almost 12 billion, and a deficit of about 2.8 is now planned against an initial budget deficit of about 1 billion as at last year. So I think these are some of the things that are obviously feeding into the cushioning allowance, which now comes through adjusting civil services employment, the civil services on salaries, and I think they will be adjusted by a factor of not less than 50, between 50 and 100%. So from a figure of an average of about 500 maybe to something just close to about 1,000 thereabout. And by implication, what this means to the fiscus is that it puts more pressure to the existing resources, because government now has to earn money at a faster rate. But of course, when you adjust the economy, the whole matrix changes, because its own revenues are dependent on what corporates are getting in terms of incomes. And so most of the corporates have already adjusted their own pricings to mirror the local currency regime. So consequently, that would also drive earnings in RTGS terms, and also what is due to Zimra in taxes in RTGS terms will also likely go up. So the initial projection was that we'll possibly reach about 6 billion in terms of national taxes as at year end, but that figure might even rise maybe close to about 9 or between 8 and 9 thereabout. But I think my worry is around the expected deficit level. I don't believe that we will close the year with a deficit level of anything less than 4 billion.
Where is that based on?
It's based on what we have already assumed, that if civil servants are allowed that cushioning allowance, it increases their bill by at least $1 billion. And when you also look at other subsidies going on in the economy, the 38.5% that's currently running, especially on the maize and other agri-commodities. That obviously also pushes up that subsidy alone will demand at least $1 billion again. And some other adjustments are going on elsewhere in the economy, infrastructure side, and so forth.
But the minister has been talking about the surplus that has been boasting about over the several months. How then would we find ourselves in a spot where we've got 4 billion?
Yeah, so this surplus, it emerged from a scenario where in the first half of the year, we were realizing a quicker growth in revenues to cost. So costs were still lagging in terms of the growth rate. So when you're looking at infrastructure projects, or when you're looking at civil servant salaries, for example, these were not adjusted at the same levels at which prices in shops were adjusted. So prices were going up, and consequently revenue that's being collected by ZIMRA is also going up. But your cost base as government, which is seen through the civil service wage bill, is quite stagnant. The infrastructure projects, of course, they would have been adjusted, but they didn't move right away because government had to seek authority to get more money so as to fund those infrastructure projects. So I think it's a dummy to say much of the money has been committed towards the building of roads, because some of the key projects have already been suspended. So what this means is that it has been deferred to the second half of the year, where government believes that after approving a budget adjustment in the second half, then they might continue with some of those projects. So all this collectively now is a rise in the cost base of the economy, and also some inflationary pressures coming from that adjustment as well. They are also likely to put further pressure on the expected deficit level by year end, which I assume will be between 4 and 5 billion.
Okay, now let's talk about bread and butter issues. 19,000 tons of wheat coming into the country just recently, and following a payment of $7 million by the Reserve Bank to Beira. What is the importance of that? I mean, we've not seen so much of bread.
I think much of the analysis that's coming out of the market is quite one-sided. Yes, it means bread on the shelves is quite improved. Its supply is quite improved. But I think whenever you see such a thing happening, when the economy is experiencing such difficulties, you need to have a further look, a closer look at what's really transpiring. For example, if you are saying that fuel supply is going to improve, and it really does improve, and yet the price remain constant against a worsening exchange rate, that tells you something. It either means that fuel is now being procured at a subsidized rate, or there's something that's not going on okay. So it's not wise to find the price of bread remaining constant, whereas the supply is improving against a worsening exchange rate. So if the exchange rate is moving, if we are using market factors to determine the price of bread and this availability, it also means that the price of bread should also increase and its supply should improve. Now we are seeing an improvement in the supply of bread, but the price of bread remains constant. What variables have changed? It's either the bakers are selling the bread at a loss, or something is happening that we are not looking at closely. Now, this is what's happening. Government is giving letters of credit to guarantee the purchases or the procurement of these key resources, such as fuel, as well as wheat and some other key imports. Consequently, if you are being given a letter of credit, it's at a certain rate. You have to submit your money. You are like procuring forex from government. But government is saying to a third party, which is your foreign supplier, I'm going to pay X dollars. But you are demanding me to pay you cash right away at a certain rate. So local guys are paying RBZ money, they're transferring money, maybe at say 6 times, and then government then says we are now in to pay your third party on behalf of you, but the exchange rate in effect is at 9. And where is government getting the money to subsidize the difference between 9 and 6? And that's also a time bomb. So as government accumulates these subsidies across different products, that gets us into that same vicious cycle where we have found ourselves as a highly subsidized nation, When we were trading at 1:1, when government couldn't sustain those levels of subsidy, it means we were accumulating debt for the country and taxpayers. So this is what it means to me when I'm looking at what the statement that was issued by the Grain Millers Association to say there's been an improvement in the supply of wheat, and government is coming to help us procure, so and so forth and so forth. At the bottom line, there is a subsidy going on somewhere. We need to know where that money is coming from and how it is going to be covered.
On that very same subject, from the post-cabinet briefing, Minister Mchangwa says that government is working on a plan to address the fuel crisis in the country. What could government possibly do to address the issues that be?
There is no alternative for procurement of the key fuel commodities that we import. Primarily, those are diesel and petrol. And these account for at least 15 to 20% of our net imports on a month-on-month basis. An alternative could only mean that maybe we are going the electric car kind of way. Or we are speeding up the production of ethanol, but you need as more land to try to substitute. And you also need vehicles which are friendly to that kind of arrangement. So essentially what they are saying is not about substitutes. They are trying to say we are going to find money somehow to procure these commodities. But what does it also mean? When we know that the government is broke, or if we also know that government won't allow market forces to come to play, because essentially government should simply allow market forces to come to play. There should be a buyer who wants to procure their fuel. They get to the interbank market, they place their bid at whatever price, and they get the supply. And they buy the fuel, they price it, and put a margin on that respective price. But this is not the case. Government wants to come in as a third hand to stop fuel buyers from paying this exchange rate which is prevailing on the market. And again, it means there will be shortages because you cannot sustainably be pushing letters of credit. Letters of credit are a function of mutual understanding between parties. So there might be a third party who might come in and say, of course, we understand that this is a letter of credit that is guaranteed by your government, but we simply can no longer give you more allowance to borrow. Okay, let me give you a clear example. We have got ESCOM, which we definitely have got a huge debt, almost close to 80 million. Despite us paying a token right now, they have had the right to reserve their own supply of electricity to Zimbabwe. So that really shows you that even though there might be third-party relationships, those third parties have a right to stop the release of their supply to local guys, and that might cause shortages unless if government allows market forces to determine the actual price of forex and the actual prices of commodities on the market. It simply means there will obviously be these gaps in the market. The other route which government has been taking over the past few years was to get some other deals. They would get some nostro stabilization facilities where they would borrow from Afreximbank or some other multinational institutions, and they would bridge the gap on a short-term basis and try to play around with all that. But all those facilities have got an interest that is associated with them. So you are putting a premium on the local economy or on the local goods. Ultimately, that's what you'll be doing. Or in other words, you are mortgaging resources, because much of these facilities are coming through mortgaging of resources such as diamond, gold, and platinum. So I think this is much of the spectrum around what all these dynamics mean. But on the net, we should always try to zoom in to determine what is the source of the funding, what is the cost to the net cost to the economy. And so far, all the measures that government has taken has not proved to be quite fruitful. They are counterproductive to the economy.
Lastly, respect, before we go, yesterday there was much contention from private sector to the minister, as the private sector is advocating for a complete liberalization of the markets in terms of fuel supply, electricity, all that. What would happen? What would play out in the economy if we liberalize the supply of bread, liberalize the supply of electricity, as well as liberalize all the essentials, maize and all that? What would there not be maybe some kind of pandemonium in the economy? What would actually...
Yes, I think we now get back to the key question here. Did we re-dollarize at the right time? Okay. So, of course, we couldn't maintain the line, but somehow it was important to get back the fundamentals in order before we could introduce our own currency. It's not also fair on the part of government to look at the private sector and to the individuals in the economy and say, but we had already re-dollarized. As way back as 2016, there was too much RTGS in the system. Who injected that RTGS system? It's government which injected that. So it was their baby to try to accommodate this RTGS and house it somewhere to preserve value. Whereas we charter a new way forward or a path back to dollarization, up to a point where we know that fundamentals are in order. So this is something that lacked. So your question is, what happens when you let market forces come to play? Of course, we're already suffering. We are buying forex at rates which are now 1:10 thereabout. That's a huge cost to individuals, to companies, and so forth. If the rate is further liberalized for these key commodities, it means a worse off outturn. It means every other product becomes even more expensive. But if this is the route to correction, then it has to be taken. Why? Because if you subsidize or if you pretend that everything is okay, like what they're doing right now, they're not telling people that they're subsidizing the importation of fuel and whatnot. Eventually, we run out of that same commodity. Eventually, we are accumulating debt. Eventually, we are pushing money supply. We have gotten huge international debt and so forth. It becomes unsustainable at a certain point, and yet the problem is really digging in. I think in as much as government has an obligation to stabilize things, they also have got an obligation to be transparent and to be clear about the charter that they're taking, which is the missing link. If we are in it together, let there be transparency, let there be a mutual understanding, and let us share a common path through mutual understanding.
I realize. Well, thank you, Respect, for the perspectives. Thank you, viewers, for staying with us. Up next is a look at the stock markets and market daily. Please stay tuned.
Climbing to the top takes more than just hard work and smart choices. It's the passion that drives you from within, the endurance to keep going through difficult times, and having a very clear vision of how to succeed. That's what we strive for at CBZ. We're a diversified and innovative listed financial services group in Zimbabwe with a complete range of activities including banking, short and long-term insurance, asset management, and property investments. CBZ has been a pinnacle for stability in the economic landscape of Zimbabwe, stemming from our deep-rooted values, our excellent customer service delivery, and our corporate vision to strive for excellence as a global competitor. Our continuous investment in research and development will cement our promise to provide customer convenience utilizing state-of-the-art technology. Relationships are at the core of what we do. We understand, however, that strong, long-lasting partnerships are not built overnight. With over 3 decades of wealth management, we have come to understand our clients and their specific investment requirements. Our unique mix of skills ensures that investment opportunities are examined from all perspectives. The balancing rocks of Zimbabwe have weathered the elements for thousands of years and stood the test of time, like majestic reminders of the fine balance of nature. They challenge our perception of what is possible and what endures. Just as CBZ has weathered the economic storms and remained steadfast throughout the turbulence of unsettled economies. Achieving the impossible through resilience and stability, we balance the elements of hard work, dedication, and experience, making us your ideal partner for success.
Good evening, ladies and gentlemen. Welcome back to Markets Daily on Equity Access. My name is Anis Chumbumu. Joining me today is the Chief Analyst, Respect Gwenzi. Hi, Specs. How are you doing today?
I'm doing good, and you, Anis?
I'm all right, thank you.
Sure.
Now, straight into the markets. The market did come up today, breaking that run of losses, consequent to a huge jump by Econet, coming up 11.01%, therefore effectively pushing up the top 10 index by 2.63%, and evidently then causing for 1.65% and 1.62% movement in the industrial index and the all share index in their respective order. Industrial settled at 638.
Before you proceed, we mentioned yesterday that these were 4-day losses, and the losses were obviously losing steam. As of yesterday's losses were just hovering around 0.1 something thereabout. And my key highlight then was that the losses were losing momentum, but this was being inspired by further weakening in the exchange rate, which obviously brought about the result that stocks could still be the only real preserve of value in such an environment.
Okay.
And just one day later, we're seeing gains upwards of 1% thereabout.
Yeah, it's very interesting that you should say that, because we have such certain counters like Econet that do react to the market very quickly and very hugely, settling at 169.75 cents. Delta being another, coming up 1.15%, Cassava 3.18%. But then something that is a little bit worrying for me, or rather it is still that investors are trying to reprice or revalue Padenga. They 6 sessions in a row, the stock has been coming off, trading with an average of about 100,000 shares on a daily basis. Not foregoing, not one day, but every day it has been trading around about 100,000.
I think if you look at Padenga, it's one of those top performing counters on a year-to-date basis.
Yes, it
It
is.
still maintains a very strong gain on a year-to-date basis, up 132%. And if you look at the average gains around across the top 10, minus Padenga, the average, minus Padenga and Old Mutual, the average is just about 20% thereabout. So I think obviously some of the investors are taking losses, because you have to also be mindful of how far up can this counter still go.
Okay.
If you really feel that it has hit the ceiling, there's no more momentum coming out of the current bubbles and all that's happening in the economy, then obviously there's no harm in taking profits at such after gaining such huge just 132% in just 6 months.
Okay.
I think it's even fair to even realize these losses, which are just an average of about 8% on a month-to-date basis.
All right. Moving on quickly, our trends have slimmed down, negative 1.43% for the all share index, industrials index down 1.51%, top 10 index down 1.02%, while the miners index is still at a firm 4.64%. We had about a couple of counters that traded on the stock exchange today. Econet being a leader of about 8 bulls, they're coming up 11%, while FMP did drop about 20% to settle at 5.04 cents. Now, within that number, we did recognize another decline in terms of volumes traded. The percentage decline has sort of declined, escaped me there, but the counter that I wanted to talk about, which had a larger chunk of the volumes traded today, would be Dairyboard. Dairyboard had a very huge number, around about 20% of the volumes traded on the stock market today, but only contributed about came in second after Econet in terms of value traded. Now, just give me a synopsis of what you think about Dairyboard as a counter. That business seems to be having a very good time.
Yes, the
time
outturn.
right now.
I think the outturn for 2019 so far has been very positive. They set themselves some very ambitious
goals.
targets, but they seem to have been on the right track to beat those targets. At the recent AGM, they mentioned that much of their key lines are performing ahead of budget, and some in line with budget. and that's quite phenomenal. If you look at lines like milk and even some of their ready to drink offerings, they really are performing well on the market. By the fact that, as you had the CE saying yesterday, there are quite some challenges in the economy arising out of a lack of power or power outages and so forth, which seeks to hamper the progress that has been made so far. And one of the other biggest challenges has been that of milk intake. Of course, they're up on last year, but the national head still remains so low. And what that means by implication is that it also increases the value, the price at which you are procuring your milk, your raw milk. So I think there's still that aspect, but they've been doing good so far in the year. What I don't readily know is the fair value that I would place on the counter, given that almost all stocks are trading at very huge premiums in terms of basic PE valuations.
All right, the CE they mentioned to do with productivity. Just a small discussion before we go on to the next movements on the market. Now, a little bit much more north toward of Zimbabwe, Nigeria did mention that they are looking to increase. They're looking to cause for the economy to grow, much to do with them actually rising their loan to debt ratios for all of the commercial banks that are within that market. Now, do you think that it would be a right move for Zimbabwe? Because I mean, one of the major reasons that the governor of Central Bank of Nigeria did mention that a lot of these banks have been sitting, and I quote, have been sitting on juicy treasury bills and government bonds and making good profits out of them, but they're not lending enough to the economy. What is your position around that?
So what Nigeria has done is to institute or to put in a decree which says banks, as at September, they should trade, or they should achieve a certain loan to deposit ratio, which simply equates the amount of loans that should be, or the amount of deposits that should be loaned out. So it's a minimum threshold to say, of all the deposits that you take in, at least 60% should go towards loans. If you look at Zimbabwe, we also have got thresholds, and those thresholds are above those of Nigeria. They presently sit at 75%, but the average loan to deposit ratio for the banking sector is below 50% as of December. And the situation is quite similar to that of Nigeria, in that there has been a serious accumulation of treasury debt in the form of treasury bills. But when you're looking at the kind of financial institution that we have, we have a government which has had a serious inclination to debt, local debt, and therefore it has been crowding out private sector lending. You're looking at yields of about 10%, which are above the normal yields for treasury bills and bonds across the world. If you look at the US, some treasury yields will be even below 4%, and some in Africa also have got yields of about 6% and thereabout. And ours were yielding about 5. They had a 5% coupon biannual, which would equate to about 10% thereabout. So these were risk-free, and obviously that also increased their allure to banks, and it was quick money. And they would also even buy from discounted treasury bills in the secondary market and so forth, and the yield would even grow. So it has been a lucrative market, and it's government which was pushing for this. So I think what also drives the LDR is also the kind of risks inherent in any kind of economy. Whenever you see that there is a high incidence of non-performing loans, then you might be driven to obviously try to reduce your appetite to lend, which has been the case with Zimbabwe. In 2016, we reached a climax of about 24% non-performing loans, and that's quite a huge amount to compromise the banking sector. So ever since there's been an introduction of Zamco, they've been buying back some of those bad loans, and the figure had now reduced to something within 10%. Of course, it is now beginning to trend upwards as well, I mean from around 8 thereabout. But all this shows the inherent risks in the economy. The economy was still quite fragile, and now that the loans, now that the overnight lending rate, or the overnight lending rate for between banks is now been increased from about 15 to about 50. What that also means is it increases the incidence of non-performing loans, because would now see interest rates of maybe even 30 to 35% on the market. And just to imagine that you could borrow money at that price and be able to pay back, you need to be earning, you need to be realizing a growth in earnings of above 30%. And to find yourself with the net profit margin of 30%, you need to be in some kind of business which is obviously not conventional or retail and whatnot. You need to be doing some bogus activities to be earning such yields. So it means a normal company cannot afford to borrow at those exorbitant rates. And even for individuals, I think it increases your ability not to repay, looking at the fact that salaries are not rising as much, and yet we have got those rates going up in terms of interest rates. I mean, that actually increases the risk in the economy. So all this is a function of many other variables which needs to be put into perspective. And so for Nigeria, I wouldn't know how the fundamentals are looking like, but they're also grappling with trying to manage the Naira and the USD, both as collective currencies in the economy. They also have got rates and whatnot which are ongoing in their respective jurisdiction. But for Zim, we have got our own unique problems.
Okay, so sorry, just to touch on the article that you also wrote a couple of weeks ago. You did mention that Ntuli is looking to dump the austerity measures. Now a couple of journals have come sort of caught onto that wind now. And,
yes.
and what Nigeria has done is somewhat in that regard, trying to expand the economy. Is Ntuli also going to look at trying to expand the economy, especially considering that we as APD Access have also mentioned this economic crisis to be somewhat of a stagflation?
I think there has been a lack of appreciation of the kind of challenges which Zimbabwe was having. We had the three-tier problems that were existing, one on the monetary, the other on the fiscus, and some which is induced by natural factors. Such as drought.
Yes.
So we have a serious drought that's ongoing right now. One of actually the worst drought in 40 years. And if you look at the impact of drought in 1992 alone, it had a huge impact on GDP, such that GDP in that respective year fell by a very huge margin, upwards of 5%. And much of it was attributed to that drought. So given that we are an economy which is reliant on agriculture and partly mining, it also follows that when fortunes in agriculture are not okay, then our GDP will be seriously affected. So if you are invoking austerity, which is simply a tightening policy which reduces expenditure and towards aggregate demand, it also implies that you are actually killing the growth in GDP. In other words, you are inspiring a reduction in GDP. So that factor also means you are impacting on that aspect of the fiscal side of the economy. On the monetary side, we had a runaway inflation which was getting out of hand. And yet, along the way, we just introduce the local currency, and yet there is serious excess liquidity in the economy, which would strike on demand and raise prices and so forth. So this is a three-pronged crisis that we were having. So there's that realization within government that we have already missed what we would call austerity, because austerity would mean you are lowering your expenditure, of course, to meet, you are lowering your expenditure to meet what you're getting as revenue, but also it means you have to reduce your net expenditure levels. So what we are now doing by revising our budget, we are simply increasing our expenditure. But of course, they choose to look at expenditure as a function of GDP. But I think it should be expenditure as a function of revenue. Why? Because if you do more than what you get, you are likely to result in a fiscal deficit, which still has to be financed. Yes. And when you finance it out of TBs and whatnot, you push money supply up. So there is a realization within government that austerity is just there in saying, but it's no longer there in principle and in practice. And what it means is that to boost the economy and to stop the kind of damage that has already been caused by these measures in terms of thwarting aggregate demand and pushing GDP downwards, which has been further affected by the drought position and also some of the measures that are being put in place to try to stop monetary growth. It means GDP will fall by a very huge margin, and there is an occurrence of inflation and the same decline in GDP to result in stagflation. And so there is now a need to put more life, to put life back into the economy, and you can only do that through stimulus. And what they are now trying to do is to put a stimulus into the economy by reversing austerity. But they can't say it clearly. They have to say it in a way that shows we have already achieved our targets, we have achieved a surplus, so now refocus and go elsewhere. But the economy cannot continue to go and grow with such kinds of punitive measures, the 2% tax, and all those overburdens on the economy, which is already reeling in some deep throes of crisis.
All right. On to the interbank rate. Today, the RBZ still experiences a strengthening of the local currency, yet some other banks are still trading very much closely to what the parallel market is doing at about 10.1 as at the close of today, while the Old Mutual implied rate is at 9.4 as the interbank rate.
But I think I saw some of the banks' quotes earlier today. The averages were still somewhat between 8.4 thereabout, which I still see was a slight reduction from yesterday, but it's obviously of course it means it's in line with the rate that, yes, the RBZ's daily rate as of today.
Okay, well, thank you, Respect. Well, will the expansion of an economy continue to happen, or will it be achieved if power is still going to be very much constrained, even though they say they're going to increase 160 megawatts into the grid? From the Equity Access team and I, do not forget to like, follow and subscribe our YouTube, Twitter and Facebook accounts at Equity Access, and do visit our website www.equityaccess.net. Good evening.
Climbing to the top takes more than just hard work and smart choices. It's the passion that drives you from within, the endurance to keep going through difficult times, and having a very clear vision of how to succeed. That's what we strive for at CBZ. We're a diversified and innovative listed financial services group in Zimbabwe with a complete range of activities, including banking, short and long-term insurance, asset management, and property investments. CBZ has been a pinnacle for stability in the economic landscape of Zimbabwe, stemming from our deep-rooted values, our excellent customer service delivery, and our corporate vision to strive for excellence as a global competitor. Our continuous investment in research and development will cement our promise to provide customer convenience utilizing state-of-the-art technology. Relationships are at the core of what we do. We understand, however, that strong, long-lasting partnerships are not built overnight. With over 3 decades of wealth management, we have come to understand our clients and their specific investment requirements. Our unique mix of skills ensures that investment opportunities are examined from all perspectives. The balancing rocks of Zimbabwe have weathered the elements for thousands of years and stood the test of time, like majestic reminders of the fine balance of nature. They challenge our perception of what is possible and what endures. Just as CBZ has weathered the economic storms and remained steadfast throughout the turbulence of unsettled economies. Achieving the impossible through resilience and stability, we balance the elements of hard work, dedication and experience, making us your ideal partner for success. Climbing to the top takes more than just hard work and smart choices. It's the passion that drives you from within, the endurance to keep going through difficult times, and having a very clear vision.